on here in the United States that we are creating money out of thin air. We're debasing the currency, and that's a great environment for buying gold. But also look at other commodities. Look at the price of oil, which has been moving up. It's at a 4-month high here today. I think the chart looks very bullish for oil. Remember, we got as high as about $150 a barrel before the financial crisis in 2008. We could be challenging those highs again before the end of 2013.
Not just hurting gold, oil has suffered its worst 2-day drop in 3 months, and the pain coming as copper has been under pressure as well. So here's the question. Is the fact that both oil and copper are selling off together a warning sign for stocks? Peter, let's go ahead and start with you. You mentioned the sell-off in housing stocks. What do you make of the price action today?
Well, remember, we had a pretty big run. We were sitting near the highs in the oil market. So, you've got a lot of short-term money in there. You hit some stops when you start to come down. So I think it's a healthy correction. I think oil prices are going higher. You just mentioned the currency war. America started the currency war, and we're going to finish it. Unfortunately, we're going to win that war, which means Americans lose, or anybody that has dollars. But you want to buy things that central banks can't print, and that includes oil and gold. And I think these corrections should be bought.
The situation in Syria is taking its toll on oil prices, or boosting them is really what we should be saying. Look at those numbers. Oil surging nearly 3% today here in the United States on concerns that the U.S. may be inching closer to a potential military strike on Syria, perhaps as early as Thursday, Kelly.
Bill, Peter Schiff is saying this is bad news for an already sluggish U.S. economy, while David Hale of David Hale Global Economics doesn't see an immediate economic threat. So, Peter, first to you. You're never super optimistic here, but you're saying this really makes things worse?
Well, but depends on your perspective. I own a lot of oil. But, I thought oil prices were going to go up anyway. I think clearly the catalyst for a $3 move today is Syria. But if it wasn't Syria, it would have been something else. Oil prices are going a lot higher than $109 a barrel, and it is a big negative for the U.S. economy. And what's happening right now in Syria is just one more weight on a weakened economy, and we can't bear the weights that we have, let alone the additional weights that are being placed upon us.
David, why don't you think higher oil prices would hurt our economy right now?
I think if we had a large oil price increase, that would be a negative. That would bolster inflation, depress real income. That would be a problem. What's unclear is why the Syrian conflict should lead to sharply higher oil prices. Syria itself, 2 years ago, produced only a couple 100,000 barrels of oil. It's not a factor. The real danger posed by Syria is it lies in the region where a lot of oil was produced. It's a conflict in some ways between Iran and Saudi Arabia. If they had a direct conflict, that would obviously mean much higher oil prices.
You said you'd be concerned if it got much higher. How much higher before you start to get sweaty palms about the economy?
$20 a barrel, $25 a barrel.
And you think we're going that higher, Peter?
Well, I think ultimately, we're going to move to $110 to $125 a barrel relatively soon, maybe in the next few months, maybe sooner if something does break out. But I think over the next few years, oil is going to take out the $150 a barrel high that we put in prior to the 2008 financial crisis, and we're closer to $200 a barrel.
Call it the big freeze at Davos. Oil prices have collapsed, and the business community here at the World Economic Forum clearly wants to know where we're headed. No one really knows. What everyone's yearning for here in Davos is a clearer view of where we're going. It wasn't long ago that oil was above $100 a barrel. In fact, that's what it averaged between 2008 and 2014. The conversation at the World Economic Forum was about peak oil. At the top of the market, everyone in the oil business was riding high. The Middle East sovereign wealth funds were buying assets all around the world, hotel and other properties, because they were flush with cash. As we survey the valley below, let's think of the oil landscape. There are 3 major producers in the world in this order: Russia, Saudi Arabia, and the United States, all pumping out about 9 to 10 million barrels a day. Then Iraq is coming on strong once they hit 6 million barrels a day by 2020, and Iran is back into the market as well. The problem is no one's willing to pull the trigger and cut production to try to boost prices. They would be giving up market share, and other people would benefit from the higher prices as a result. After the peak, we've entered a new phase, which some are calling the super glut. It's been a steep ride down in terms of prices as a result, going from a peak of $115 a barrel in June 2014 to having broken $30 a barrel, and no one knows where the floor is. This is going to lead to cost cuts and projects being shelved. Already, nearly $400 billion worth of projects have been iced so far, and many in Davos are still trying to figure out where the bottom